Here's Brian, who's in Bobcaygeon, Ontario. Hi, Brian.
Hi. Could I have your guest thoughts on NXP Semiconductors? Does he own it, and would he be a buyer at this price? I get the feeling from earlier comments he may prefer NVIDIA in this space. Thank you.
Yeah, Brian, you know, when it comes to semiconductor companies, there are companies that lead for a while and then go through pretty good sized corrections. And so you do have to be fairly active as an investor in a lot of these technology companies. And NXP had a tremendous run into the spring of this year and started to back off. And as many people know, we use stop losses on our positions when, if you were to look at a point and figure price chart, which I'm not sure you guys have, stock broke down fairly decisively at $90 and is yet to reestablish itself technically. And there are others, as you mentioned, and NVIDIA would be one example of semiconductor companies behaving better. So it's one that I watch. Fundamentally, it's an attractive company. Their most recent quarter, their earnings per share growth slowed, and I think that was a concern. And so technically in the near term, it's kind of broken. I like the semiconductor space. One of the things you may consider doing is looking at either XSD, which is an ETF with a basket of semiconductors, and it's an unweighted basket, meaning that many companies contribute to the return, not just the biggest ones, or SOXX, which is market cap weighted. Both of them are behaving pretty well.
Just quickly here, David, when a stock does break down technically, how long do you find, well, I mean, if and when it does recover, does it take 2-3 months maybe at least?
So here's the issue. When a stock breaks down technically, if you were to look at the price chart of NXP again, basically over the last 5 months, everybody who bought the stock, or for the most part, is underwater. Right? And so the problem that you have is that you've got all these people who would like to have their money back, right? And so if we're in a decent market here, I like to own things where you got a lot of happy shareholders, not a lot of built-in sellers. So I would say that the share price needs to do some work, give people an opportunity if they decide they want to exit the stock, to sell their stock. And given the fact that in any portfolio, 20 to 40 companies makes a diversified portfolio, you don't need to own one that's technically broken, no matter how good the company is.
There's NXP over 5 years. On to Doug, who's in Stratford. Hello.
I just like to want to exit the stock, sell their stock. I realize. Given the fact that in any
okay, Doug, could you turn your TV down, please?
Pardon me?
Okay, I think we're good now. That's okay. Go ahead.
Yeah, I just like your opinion on Whole Foods. I know it has had some competition from the likes of Kroger, but it's trading near a 4-year low, and I just wondered if now might be a good entry point.
Right.
I'll hang up and listen to your guest's response. Thank you.
So, Doug, I'll be a bit short and sweet on this one. Again, we aren't value investors. I'm never going to tell you to try and pick a bottom, especially when we're in a market that's rallying and this is sitting on the lows for the year. Again, you're going to have tax loss selling coming at you. Money, I believe, is going to work towards the leaders through the balance of the year as people chase performance. I will argue that 85% of hedge funds so far year to date are underperforming the market. They're underinvested. They are going to be looking to buy the leadership stocks, not likely the broken stocks. So I don't know where the bottom is on this one. I like the sector, but they have lots of competition, and I think that's a problem for them in the near term.
We're going to show Whole Foods here against Kroger, as we are there. Kroger outperforming. Would you say the Krogers of the world have caught up and they're offering a lot more products just like Whole Foods?
Yeah, I mean, look, it's not lost on the world that people are trying to buy more healthy food. And so some of the very large chains have figured that out. And it means that it's hard for Whole Foods to get the kind of price that it was getting historically, and so their margins are under pressure.
It's a really interesting chart. Okay, last one here before a market call in a minute. We have Danielle in Newmarket. Go ahead.
Hello, Mark and David. Thanks for taking the call.
Sure.
Crescent Point. We're well underwater in this stock. We've just been hanging on by fingernails because it's one of the only that we own in that sector. Is this worthy of patience where it's at now and a long-term hold? They lowered their dividend last week, as everyone knows. Do you see a further lowering of the dividend? How's their cash flow? Go ahead, please.
Okay. I'm going to put this in the same boat as Husky and Tourmaline. You just don't need to own this right now, right? There's other things to focus on. You have a mountain of shareholders who are underwater just like you are, waiting for their price to get the money back. It's all relative. You can take those dollars and buy something that is winning today, that has happy shareholders, where things are getting better, not worse. So I would tell you to take the loss. Hopefully you've got some gains to write it off against, and move on.
So in simple terms, if and when CPG starts moving up, there's a group waiting at 20 to get their money back, 25, 30, that kind of thing.
It's why you want to be very careful of something, you know, that is underwater and has been underwater for quite some time, because you know that all kinds of those folks that paid higher prices are saying to themselves, if it just came back to my entry price, I'd be a seller. Now compound the fact by the fact that we're headed into November, which is notorious for tax loss selling, and we're in a good market, so there's other things to do. I would just say move on.
Thanks, Danielle, for that. We have lots of questions here for David. We couldn't get to them all, although we can in a different kind of format, the Market Call Minute. Mark in Brampton had a call about Staples.
I would not buy Staples. It's one of the retailers that's underperforming. If you want a big box retailer, look at Costco. Costco's hitting new highs, Staples hitting new lows.
Ben in Toronto wants to know about Walt Disney out with earnings this coming Thursday.
Yeah, Disney is a company that we got shaken out of in July of this year. We have repurchased the shares, technically very attractive, lots of different streams of revenue and profit coming. It's a leading company in the media group.
Ken in PEI, he called in about Visa, which is buying Visa Europe for over $23 billion. That deal was in the wind.
Yeah, financial technology companies look very attractive. MasterCard, Visa, Fiserv, I like them all. I would buy Visa here.
I'm guessing your answer on this one, email from Steve on Bombardier, not your style, right?
I think that there are too many questions as to how they are going to fund the C-Series program. And it may well be that it goes ahead, but they may wind up with a very small percent of the cash flow, depending on whether they can fund it internally, which is a question mark, or whether they need to bring in outside capital. There's better places to be.
Last one here from Tim, emailing from Las Vegas, of all places, LyondellBasell.
This is a company that we've owned over the last 3 years. We haven't owned it recently. The chemicals group, I think, does very well with low natural gas prices, which of course we're getting. The chemicals sector is improving. Technically, the stock's getting better. It put in its low early in the winter last year, and it's been improving since then. We don't own it. I have to say we're taking a look at it right now.
Okay, very good. That's the Market Call Minute. We have top picks from David coming up right after this. We have a consumer/internet company, an industrial, and a technology company. Stick around for those.